Nedgroup Investments offers clients access to a range of South African and offshore unit trust portfolios. The company's best-of-breed approach means that they research, select and monitor available investment managers on an ongoing basis. The group also partners with independent financial planning businesses. Joining us from Cape Town to discuss the group's investment strategy is Anil Jugmohan, investment analyst at Nedgroup Investments. And I'm going to hand it right over to you at this point because I know you've researched this topic extensively.
Thanks, Bronwyn. And Anil, I was reading some research that you did earlier on that suggested that many investors would be better off simply sticking to the investment that they set up initially rather than chopping and changing investments as they see a flow of information coming across their news service. Can you just give us a little bit more detail on that?
Yeah, so it is perhaps an unfortunate scenario where you actually get, for the majority of the time, that a lot of people, when they invest into a fund, they actually take quite a shorter term view when making that investment. Now, unfortunately, it usually results in the fact that they're quite impatient and they don't actually give the fund a chance to actually produce those returns, which are more likely over the longer term, but far less certain over shorter time periods.
Anil, what do you think sparks that impatience? Can we blame the media?
Listen, I gave you the right to ask the first question. Certainly not to
very special and specific role. And in terms of information flow, as time is going on, we're actually far more fortunate than, let's say, a few decades ago, where people didn't have as much access to information. But of course, it really depends on individual investors as well as their financial advisors in terms of what they do with that information. So our stance is that the media does actually provide very valuable service, but it really depends on the individual investor in terms of how they use that information and how it actually translates into portfolio actions with the investments.
And no, I just want to remind Kevin what you've said there. We provide a very valuable service and we're special.
He is being diplomatic.
We are special. I love that. Thank you, Anil. Right, now, let's talk about your investment strategy in this uncertain environment. We've just had a conversation coming out of our previous gentleman from Trident Asset Management, and he was saying asset diversification, this is Kimon Boyaki's, asset diversification is the key in this environment. Do you agree with that philosophy? Is it about having a little of a lot of different things?
Yeah, so right now we're not seeing particularly great value in any single asset class. So given the current valuations and prices of the various asset classes, both locally and abroad, we actually don't have a high amount of conviction in any single asset class. I mean, I can tell you that we do think that US government bonds are extremely expensive. Now, as you know, investors tend to look at past performance and they say, well, bonds have actually done very, very well over the last, let's say, 30 years or so. And therefore, they think that the same kind of performance will be produced going forward. But we actually try to understand the components of returns for the various asset classes. And we try to understand what actually drives these components of returns and eventually what actually drives the eventual returns that an investor would receive. So given our analysis and the various scenarios that we think might actually play out both locally and abroad, we think that perhaps a lower equity balanced fund, which is quite well diversified, would be quite a good bet for, let's say, on a 3 to 5 year view.
Anil, when you say low equity, have you got some sort of sense of what sort of weighting you would typically have? So let's take a balanced portfolio. I assume you're talking about a fairly conservative portfolio. What typical type of allocation would you have to equities? What sort of percentage allocation?
Yeah, so surely for each individual investor, it really depends on their circumstances and their objectives. But let's say in general for the current environment, we'd say maybe about 35–40% South African equities. And let's say if you're looking at a Reg 28 portfolio, which allows a maximum of 25% offshore, we'd try to take probably maybe 20–22% offshore and the majority of that in global equities. Because as I mentioned just now, we don't think that US bonds in particular are quite attractive. And in the European area, it tends to be, you have to be quite careful where you do invest. So I guess those would be the major components of a portfolio. We'd be maybe 10% or 15% in local property, and the rest would be a careful mix of bonds and local cash.
When you talk about bonds on the local front, can you break those down a little for me? Where do you have the most appetite? Are we looking at the corporate bond arena? Are we looking at the government bond arena in South Africa?
So, I mean, as you know, the major determinant of bond returns looking forward, let's say over 5 or 10 years, is actually the current yield that you're going to get from a bond. Now, assuming no default, it seems like corporate bonds will give you a much better return looking forward. But of course, depending on demand and supply, over the coming months and years, yields could be pushed up quite significantly. Now, as you know, when yields do get pushed up quite a lot, the prices of bonds tend to fall. And as an investor in those bonds, you can lose a significant amount of capital. And depending on your risk tolerance, it may be far more than you can tolerate. So once again, it does depend on the individual investor's preferences. But we do think that corporate bonds probably looking more attractive than government bonds at this point in time.
And Neil, would you be in this portfolio that you're constructing or have constructed, would you have exposure to gold anywhere as a specific investment?
So gold does play quite a specific and quite an important role, particularly as a type of insurance. And sometimes it can be used quite successfully as an inflation hedge. Now, if you look at gold's performance over very long periods of time, and I'm talking specifically about the Rand gold performance, it actually hasn't done very much better than cash over very long periods of time. Now, we've also done a lot of work in terms of how cash has performed. And over long periods of time, once again, cash has only really given you about 1% above inflation. So it's particularly in times of extreme uncertainty where the price of gold tends to spike quite significantly. And also as an emerging market, the Rand does actually depreciate quite significantly versus the dollar as well. So a Rand investor in gold actually tends to do quite well during times of extreme uncertainty. But when things cool down a bit and when there seems to be a greater uncertainty of the outlook in the global environment, that's when the price of gold actually comes down. So particularly in these tough times as we're experiencing now, gold can actually be quite a good hedge for your portfolio.